Literacy Speaker Series for Spring 2018. Your speaker today is Mr. Paul Lim. Paul is a certified financial planner from LLP Financial, and he is also a huge volunteer for San Diego Financial Literacy Center, who is one of the underwriters, as well as our friends from Cal Coast and Mesa Foundation, and California Burrito is also underwriting this. So you're going to listen today about income taxes, all of the great stuff that's going on with that, and some of the changes that might be coming down the pipe. So without further ado, Paul.
Thank you. All right, good afternoon, everybody. Actually, still the morning. My name is Paul Lim. I'm a certified financial planner professional. I'm with LPL Financial and also a volunteer with the San Diego Financial Literacy Center. My firm is called the Wealth Consulting Group as our DBA. Today, I want to talk with you a little bit about income taxes. It's something that we're all going to encounter at some point in our lives, but I think it's very poorly taught, if at all, in any of our schools. And I will say that income tax rules in America are needlessly complicated. And so my goal today is to help you to simplify some of the ways in which we approach income tax, not to be intimidated by any of the moving parts that are there, and really to give you some clarity, not only about how the system works, but about specific action steps that you can take in order to just be as efficient as you can from a tax perspective. So just some quick housekeeping items. Everyone got these handouts today, right? Okay. I will mention to you that on this first handout that we're going to look at primarily, most of the information here is accurate. I will say that there was a new tax piece of legislation passed just last year, so these items of information are only about 2 months old. So everything we'll be talking about today is going to be in generality. I may have to simplify some items just for the sake of discussion. Just a quick disclaimer, I am not a CPA, I am not a tax attorney, so nothing here should be construed as a recommendation. We're talking about these ideas and concepts, so anything should be verified by appropriate advisors before being implemented. So anyway, that's the main part that we'll go over. Really what I want to share with you first is about the main ways in which income tax is calculated. So the first thing we're going to look at right now is the upper left-hand table that you're going to find on this chart. This table will show you what's called a progressive income tax in America. And what it means is that different parts of your income are taxed at different percentage rates throughout the year. So for example, as a single person, the first $95.25 that you make as a single person is taxed at 10 cents per dollar. So the government takes 10 cents of those dollars. From $95.25 to $38.7, it's 12 cents. From $38.7 to $82.5, they take 22 cents of those dollars. Now, just because you go into the 22% tax bracket, it does not mean that all your money is taxed at 22. It's only those dollars in those specific ranges. So I like to use a picture in order to kind of really articulate this concept a little more. So imagine like your income is a pile of $1 bills. And let's just pretend it's $100,000, just to make the math easy. So the first $9,500 in the pile, these dollars are taxed at 10 cents. And then from here to 38.7, these dollars are taxed at 12. 2, 24. And so you can see that this is the way in which the amounts are taxed. So pretend that different parts of the pile are taxed at different percentage rates. These dollars are taxed at 10, then they take 12 of these, 22 of these. But just because we're here, it doesn't mean the whole pile gets taxed at 24. It's only those specific dollars in those specific ranges taxed at those particular rates. So what this does for us is a couple of things. We can now get a better understanding of some terminology. So I want to just verify for you a couple of terms that will help you to better understand certain topics as they're discussed. So the first thing we're going to talk about is something called our marginal tax rate. So a marginal tax rate tells me at what rate a subsequent dollar would be taxed if I earned one more dollar. So let's pretend it's New Year's Eve and I've earned $100,000 all throughout the year. So from January 1st all the way till the end of the year, I earned $100,000 exactly. And then on the very last day of the year, someone says to me, I will pay you one additional taxable dollar if you help me do this favor. And you'll say, okay, and you think to yourself, at what rate will that dollar be taxed? Well, that dollar is going to go on top of the pile, right? And so we know that if I add one more dollar to that pile, I'm going to pay 24 cents on that dollar. So I'm really only going to get to keep 76 cents, if that makes sense. So a marginal tax rate tells me how much I'll pay in tax for one additional dollar of my income at the margin. At the very next dollar, what is my marginal rate? So that tells us what it is over here. So that's our marginal tax rate. There's another figure that we're going to look at. But in order for us to calculate that, I want to show you how to read this table to figure out how much you pay in tax. Do you see the taxes due portion over here? What this line tells you is it tells you the way to calculate how much federal tax that you owe on any given dollar amount. So for example, if I'm in the 10% bracket, it basically says that the way I calculate my taxes is I take 10% of the amount over $0. That's pretty easy to understand, right? Because if I make $8,000 and I'm in the 10% bracket, I'm just going to pay $800 in taxes. Pretty straightforward. The next line tells you if you're in the 12% bracket, well, you're going to pay $952.50 plus 12% of the amount over the threshold, over $95.25, where that bracket began. And that makes sense because $952.50 is all the taxes I paid in the previous bracket. Let's jump over here to my $100,000 income earner. My $100,000 income earner is in the 24% bracket. And so what that means is that they've paid $14,089.50 in all the previous three brackets, and the way to figure out how much they add is 24% of the amount over $82.5, which is where the threshold began. Does that make sense so far? Okay, so let's do a quick calculation. What is my excess above $82,500? Well, I know that's $17,500, isn't it? So if I take $17,500 and I multiply that times 24%, I get $4,200. So $4,200 is how much I paid in this particular tax bracket. But how much did I pay in all the previous brackets? Well, we know with our cheat sheet, right? It's $14,089, so I have to just add that together. So the total amount of tax that I paid on that $100,000 of taxable income was $18,289.50. So you'll notice you didn't really pay 24% on all your money because different parts of the pile were taxed at different rates. But what if I could calculate just a flat percentage against my income that would give me the same number? Well, that number is called our effective tax rate. So if our country had a flat tax, for example, where every dollar is taxed exactly the same, and if that rate was 18.28%, well, I'd get the same number, wouldn't I? So really what we're looking at in this case is we're trying to figure out how much of my money actually went to taxes as a percent of all of my income together. That is called the effective tax rate. If you're going to ask yourself, how much tax am I going to pay on one additional dollar of income? That's the marginal tax rate. So this is something that's important to understand because unfortunately when conversations and debates come up about tax policy, people will interchange those two terms very much, and they just rely on people not to understand the difference when they're debating those items. So generally speaking, if you want to make it sound as though the person you're describing is paying a lot in income tax, you'll usually talk about their marginal rate. So you'll usually say, well, this person will pay 24% in taxes if you do this, and that kind of makes the amount sound high. But if you want to make it sound low, like someone didn't pay very much in taxes, usually you'll look at their effective tax rate, because what this number takes into account is not only all the lower percentages that you paid in the beginning, but also all the deductions and things of that nature that are reflected in the final number, which we are going to go through in more detail as we get to that section. But my point is, there are two different ways to express this taxpayer's tax rate. One is the marginal way, and that answers 24. One is the effective way, and that answer is 18.28%. So you can see that it's important just to understand this difference so that the distinction is clear. And if you ever hear somebody talking about various tax rates, you can dig a little deeper and say, well, what are you actually referring to? Are you talking about an effective rate or a marginal rate? And then you'll actually know the difference when presented with those facts. Make sense so far? Okay, very good. We're now going to talk a little bit more about how we get to this number. Because what I just showed you is not actually the figure that is assessed against your gross income. You don't pay this on your gross income. You pay this on your income after you take a bunch of deductions and credits. So you actually get to amend your number before it goes through this table. So that $100,000 that I showed you there, that's not that person's gross income. It's what they're called their taxable income. So how do we arrive at our taxable income? We're actually going to walk through this together on our second handout. So just everybody had their second handout together. We'll go through this. Believe it or not, the tax return is only 2 pages long. It's the Form 1040, page 1, page 2. If you look at these 2 pages from a person's situation, you can pretty much get an idea of what their life is with respect to income taxation. The reason why those returns get so big sometimes is because there are all these different schedules that support the numbers that are ultimately dragged over onto this page. So let's talk first about the income section over here on the tax return. I'm really going to simplify how to read this. If you look at it from the top, it appears very complicated, but it's really not that bad. If you look at this section right here, this is all income section. The second section that's in this part of the page, we're going to call these the good deductions. Now, every tax deduction is good if your goal is to pay less in income tax, which I assume it is. But if your goal is to pay less in income tax, every deduction is good. But some deductions are more powerful than others. So if the deduction happens on page 1, we call these above the line deductions. So the line that separates page 1 from page 2 is the line. And we basically say, if it's a tax deduction that occurs here, it's an above the line deduction. It's a really good deduction. That's the ones we'll talk about. You get some deductions on page 2 as well. And we're going to call these below the line deductions because they're happening below the line. These are also good deductions, but they're not as powerful. And then when we get over to line 43 on page 2, that is the number that goes through this table. So there's a lot of steps and a lot of things we get to do to our taxable income number before it goes through this table. And so that's the purpose of the next portion of our discussion. Let's take a look at the income section. It's basically lines 7 through 22. And we'll highlight a couple of things that you might look at over here. So line 7 is basically W-2 wages working for a company here. I'm sure many of you have received a W-2 in the past before. Then we have line 9, for example. If you own any mutual funds or maybe stocks in a trading account or something of that nature, sometimes those stocks or those mutual funds will pay out dividends to you. And those are subject to income taxation. So whatever those are, those get dragged to that line. Then take a look at line 12. Some people, they might own a small business, for example, and you basically get to take the profit or the loss and you drag that to that line. Take a look at line 17, for example. If you own an S corporation, which is a different type of corporation, or if you have rental real estate or something of that nature, you'll basically take that number and you'll drag it over here to this line. So you add all of that up together, and then line 22 is your total income. So lines 7 through 22 are basically all the things that make your income number big, if that makes sense so far. Then we start to get down to adjusted gross income. These are above the line deductions. And I want to share with you what a deduction actually looks like. So we know in our table here that our person is in the $100,000 income earner is in the 24% tax bracket, right? Which means that if they make an additional dollar, that means that they have to pay 24 cents in income tax. But if they get a deduction, that means each deduction is worth 24 cents in refund to them, in essence, or owing less. So if you think about it, if I manage to find $10,000 of deductions for this $100,000 income earner, well then the number that goes through the table is not 100, it's actually 90. So when you're finding $10,000 of deductions, for example, what you did is you just prevented $10,000 from being taxed at 24%. You basically shrunk the pile by $10,000. You just took $10,000 off of the top of the pile, if that makes sense. And so if those would have ordinarily been taxed at 24, that means I just saved $2,400 in income tax. That's not bad, right? So this is why we start to look very hard for tax deductions, because we can see that that's very valuable. Make sense so far? Okay, good. So let's talk about some examples of deduction. So now we're on the 1040, and let's take a look at line 25, health savings account deduction. As some of you start to enter the workforce, you may run into some situations where your employer gives you a choice as far as your health insurance is concerned. And so some places make you take one particular plan, some will allow you to select from a menu. But let's just pretend that we were able to select from a menu. Let's take a typical PPO type plan and an HSA. This is a good exercise on health insurance too. Let's pretend that this particular health insurance plan costs you $500 a month. So that's $6,000 a year. Now this plan over here maybe only costs $250 a month. So that's $3 a year. But the difference between these two plans is as follows. This one has a $2,500 deductible. So the deductible, if you ever see deductible in your health insurance, that's the portion of your bill for which you are 100% responsible. So you have to pay the first $2,500 before the insurance company starts to kick in a dime at all. So that's a deductible. Over here, maybe you have a $4,500 deductible. So you look at that and you say to yourself, oh, you know, that's $2,000 extra dollars if I go to the hospital. I have to pay an extra $2,000 towards my bill before my health insurance company will ever pay me anything at all. And so at first, that deal might seem unattractive. But then what you realize is you look at the difference between these premiums. And you say, you know, I'm going to save $3,000 a year just in premium for myself, for the difference here. So I'm actually not that concerned about the difference between these two deductibles, because what my employer will let me do, they'll let me open up an HSA. And with the money I save over here, which is $3,000, if I put the $3,000 in an HSA, then I can use that money to pay for this deductible, which is really the difference between these two. So although I'm subject to $2,000 more in costs, I saved $3,000 in premium. Yes?
Did you mean HMO instead of HSA?
No, this is HSA. This is a different style of PPO plan that is HSA compatible. So all HSA plans are PPOs, but you have to have a very high deductible in order for the plan to be HSA compatible. HMO is a little different. HMO is basically no deductible. You just have co-pays. So you'll visit the doctor's office or a specialist visit, and it's a $25 copay or a $75 copay or something like that. The drawback to the HMO is you have to stay within this very narrow network of providers, in essence. You can only go to certain doctors. PPO is different. You can go to whomever you want, as long as they're approved within that plan's network and everything of that nature. But the plan styles differ. So HMO is different than HSA. But HSA is a style of PPO. I know it gets a little complicated, but yes?
So anything above 2,500 on PPO, I can ask for back?
Well,
Or
the
is it only
insurance
after
company,
that?
well, the insurance company will start to pay for some of the bill. So usually, past 2,500, they start to pay 80 cents per dollar, and then you pay about 20 cents per dollar.
Okay.
So let's pretend I had a $5,500 medical bill. Well, I pay the first 2,500 myself, and then of the 3,000 that's left, they pay 80%, which is $2,400, and I pay $600. So I'm out of pocket $3,100 on a $5,500 claim. That's kind of the way the cost sharing works in there. But you'll notice that before the deductible, they pay nothing. So it's 0, 100 insurance company patient. But as soon as you pass the deductible, well, now it's 80% insurance company, 20% patient. So different class, but still applicable. But yes?
What tends to be the most common choice?
It depends on one's circumstances, but I will say that most people tend to go PPO because HMOs are very expensive these days. And again, it's different. San Diego's kind of an HMO sort of a town, but generally speaking, because of the cost structure associated with PPOs versus HMOs, these are almost always more expensive. Not always, but almost always. So most people do gravitate towards this. And I will say that the trend for most employers is towards this and also even more towards this. Because you see double-digit rate increases on health insurance every single year, it's just unsustainable. And so in order to help with that cost, many employers have started to migrate towards this. So it's an important concept because the young people really might start to see this a lot more as they enter the workforce. And this scenario works very well for you if you're young and healthy and you don't have a lot of medical utilization. So what you could do in this example is you take the $3,000 in savings that you experience by taking a less expensive plan, you contribute it to an HSA. And in doing so, you get a tax deduction. If I contribute to the HSA, I get to subtract $3,000 on line 25 as an example. And if I do get sick, even though I had to pay $2,000 more in my deductible, I have $3,000 in my HSA. And so when I take the HSA dollars and I use them to pay for medical expenses, it's tax-free. So now imagine if you had a year where you didn't have any medical expenses. Well, you just banked $3,000, that money rolls over year after year, it's not use it or lose it, and then next year, you can put an additional $3,000 in there, and then you'll have $6,000. And the more and more years that you're healthy, you just bank those savings. If you had a year where you owned this plan and you were healthy, that $3,000 disappears forever because it goes to the insurance company. You're never going to get that back. What you're doing in this case is you're shrinking your costs, putting it into your own account with your name on it, and using it yourself to pay for your own medical costs as they're incurred, if they're incurred. So anyway, that's the whole value proposition with the HSA. But my point is, in the income tax discussion, if you contribute to that, you get a deduction here. It's a really good deduction. It's on page 1. Yes?
So let's say after 2 years we have no medical expenses and then we would have $6,000 saved up, would it still be, and then we have a $4,600 bill, would the $100 still be the 80 cents covered by the insurance company, or would just all the money we save up go to that?
Okay, good question. So yes, in that example, what you would do is if I had $6,000 in my HSA, I'd have to shell out $4,500 first just to satisfy this. And with the remaining $100 that's left, I owe $20, and they'll pay 80. So I'd really have to pull out $4,520 for a $4,600 medical bill. So that's correct.
And in that same example, so then when you're filing your taxes the next year, are you deducting the same $3,000 for the additional $3,000 you put in, or do you deduct the whole $6,000 because it's in there?
Every year-by-year contribution is what you deduct. And fun fact here, you can actually go back in time and fund your HSA up until your tax filing deadline. So for example, if I didn't make HSA contributions in 2017, you might think, oh, it's 2018, it's too late. It's actually not. You can actually retroactively fund it for 17 if you want to, before you finish your income taxes. So just like an IRA, you can do that with an IRA too, and we'll talk about that in a second, but you can retroactively fund it. In fact, if we look at our cheat sheet right here, you see where it says HSA contribution, single? That number is $3,400. hope those are updated. But anyway, it's close if it's not. 3,400 is the amount as a single person. If you're married or if you have family, 6,750. So it almost doubles in that case. So my point is, if you've got 3,400 lying around, and you have an HSA compatible plan, and you did not contribute for last year, and you've not filed your income taxes, and you're looking for deductions, you can actually go back in time, fund it, code it as a 2017 contribution, and then take the deduction on this year's filing for 17. So that's an example of a good deduction over here. All right. Let's take a look at line 32, for example, IRA. So IRA stands for Individual Retirement Account, and it's a way for us to really talk about saving for your future, but also decreasing the number on which you pay income tax in the process. So annual limit is $5,500 for being younger than 50. So let's pretend I put $5,500 into an HSA, I'm sorry, $5,500 into an IRA and $3,000 into an HSA. I couldn't do that. So $5,500 to my IRA, and let's say $2,500 to my HSA. I want to make it an even number, so it's easy to do that. So I just got $8,000 of deductions right on page 1. So if I'm in that 24% bracket, I just prevented $8,000 from being taxed at 24%. It's a big deal. Let's see how big of a deal it is. Almost $2,000. $1,920. So you'll either get a refund that's $1,920 larger, or you'll owe that much less. Just think about it. Okay, what else on here? Student loan interest deduction. The rules on that kind of changed recently, actually, in 18. So that one's going to be different. But again, this is a 2017 tax return, so it still kind of counts for part of last year. All of these different things on here, generally speaking, are the good deduction. It's a way to chop the number down. And again, because they happen above the page 1, call them above the line deductions. Now let's go to page 2. Let's draw our attention to line 40. All right, so on line 40, what line 40 tells us is it says itemized deductions. And we're going to just define what those terms are. Okay, so there's two different ways to pick your deductions on line 40. You can either itemize your deductions or you take the standard deduction. I'm going to give you an example here. So if I itemize my deductions, I'm going to give you some examples of itemizing here. Charity, mortgage interest. So we spent a lot of time in a previous class talking about the amount of your house payment that is attributable to interest. You get to essentially get a deduction for that because it's the government's way of saying, oh, I'm so sorry you had to pay interest that went like this and disappeared to a lender. And so I'm going to give you some relief on that. And it's a way to make you pay less in income tax because part of your housing payment didn't go to pay on your loan, it went to enrich the bank, so to speak. So that's a way to get deductions there. Medical expenses, some medical expenses. So I'm going to share with you the reason why page 1 deductions are more powerful than page 2 deductions, which is really these things. Do you notice on line 37 that we come up with a figure called adjusted gross income? Basically, after you take your page 1 deductions, you come up with a figure called adjusted gross income. So let's pretend that on page 1 I found $20,000 of deductions, and therefore my AGI is $80,000. Follow me so far? Because I had a gross income of 100, and I found 20,000 of page 1 deductions, and it turns out when I add and subtract all those things, I get 80,000 on line 37. Well, there's a rule that takes AGI into account, and it has specifically to do with medical expenses. Basically, you get to deduct medical expenses to the extent that they are higher than 10% of your AGI. So, let's pretend I had $20,000 in medical bills. Well, 10% of my AGI is what? 8,000, right? So do I get to deduct the full 20? No, I don't. I only get to deduct 12 because this minus this is 12,000. What if I was really good at tax planning and I was so aggressive that I found not 20,000 of Dutch deductions, but 40? That would mean my AGI is 60,000, right? So now 10% of 60,000 is only 6,000. So now I don't get to write off 12, I get to write off 14. Does that make sense as far as the reasons why page 1 determines what you can deduct on page 2? Yes?
Are medical expenses the only area that have that rule where it draws upon AGI?
No. There are actually lots of things that take AGI into account. And so usually the lower you can get AGI, the more of those applicable deductions you get to realize. So yes, it's not just those. I'm giving you some high-level examples that are easy to discuss, and there's a whole litany of itemized deductions in that way. So anyway, what we do is we add up all these things, and we figure out what our total number is. So in this case, let's just pretend as a single person here, my total deduction is 19,000 itemized. But see, some people don't keep receipts throughout the year, and they don't have a lot of these things happen. Maybe they did donate to charity, but they can't document it, and not everyone is as conscientious as they might want to be if you're doing really serious tax planning. So what the government says, they'll say, tell you what, I'm just going to take your word for it. I'm just going to give you a number. It's a standard deduction number. It's 12,000. So you can either add up all your receipts and try and get as big a number as possible, or we'll just take your word for it and give you 12,000. Now you actually get to pick between which one you want to take. And if our goal is to pay less in income tax, which it should be, then you're going to want to pick the higher of the two, right? So what you do is you're going to itemize, see how big that number is, and then compare it to the standard deduction. And then you take the greater of the two. So sometimes you'll see people take efforts to do something where they'll say, oh, I'm going to donate this amount to charity because it's a write-off to me and I'll get it, and that's just kind of the cocktail party talk that you'll hear sometimes with tax deductions. But it's like, you have to realize that those only count once you exceed the standard deduction. So someone might think to themselves, well, I'm just going to donate $8,000 to charity and realize it over there and have that happen. Or realize some itemized deductions here. I'm going to take these medical expenses, I'm going to accelerate. I'm going to try and itemize and do something over there. But it doesn't count unless you are higher than your standard figure, which for this year is $12,000. So you don't get both. You don't get to double count. It's one or the other. It's not both. So you just have to keep those things in mind. Generally speaking, in the earlier phases of life, you're going to largely take the standard deduction, which is completely fine. But as your situation gets more sophisticated, you may find that you are itemizing in the future. So that's the discussion on here. Take a look at the standard deduction numbers that you'll find on page 1 of the cheat sheet. If you're a single person, your standard deduction is $12,000. If you're a married person, your number is $24,000 as a couple, for example. So those are very different from the numbers seen previously. But in essence, that's what you have to evaluate. You have to figure out which of those apply to you and then try and beat that number if possible. Yes?
So why on the 1040 form does it say different figures over there in standard deduction? Is that replaced by the cheat sheet you gave us?
This is for 2018, and then this tax return is 2017.
So something different in 2017.
Absolutely, yeah. So these numbers were totally different. So in 2017, the standard deduction was $6,350, and as a married person, it was $12,700. So part of the new tax law that went into effect changed those numbers. So good observation. It's different. Yeah, a lot different. So in any case, that's where that part comes into play. Make sense so far? Okay. One other item that is worth mentioning in this case is about state income taxes. So take a look at these tables right below with California. There's California single rates, and then there's California married rates. Now what happens in this case, and I have to do a quick disclaimer on these too. These are the 17 California income tax rates. The Franchise Tax Board is very late every year in releasing their 18 rates. I don't know why. It's something that happens. I usually get these in the middle of the year. But these are old rates, just so you're aware, but it's still good enough for our conversation. If you take the standard deduction, then what you do is you add these rates together. So for example, if I'm a $100,000 single person and I look at the California rate, which bracket am I in? In which bracket am I located? That's the right way to say it. 10.23, right? That's right. So I'm in the 10.23 bracket. So if I'm in the 24 bracket as a single person making 100, and I'm also in the 10.23, well then I really pay a total of 34.23. That's how much I pay between federal and state. If I itemize my deductions, I actually get a deduction for the amount of state taxes that I pay. So I'm going to give you an example. And this is kind of a simplified example because otherwise it gets too complex. Let's see here. I'm just going to say 8,000. So let's pretend that on 100,000 of income, I paid 8,000 in California tax. So it's 92. When I go to the federal government and I talk to the IRS person, they should not tax me on the full 100,000 because I would say to them, I said, whoa, that's not fair. 8,000 of my money went to go pay Franchise Tax Board in California. You shouldn't tax me on the full 100. You should only tax me on 92. I didn't even get to enjoy that 8,000. And they look at you and say, okay, you're right. I'll only tax you on 92. That is called a state income tax deduction. So why should you get double taxed on money that you already sent to Jerry Brown for taxes? That's not fair, right? So the 8,000 that you paid in California tax should get deducted from your income. And you should only pay federal tax on 92. That's kind of the point behind it, is what happens if you itemize. Now remember, if you don't itemize, if you just take the standard deduction, you do add them together. And chances are, if you're taking the standard deduction, you may not even be paying that much in California tax anyway, so it's kind of a moot point. And it's usually indicative of a less sophisticated circumstance, which is totally fine, by the way, but it's a different set of rules. So we're only talking about people who itemize and people who do get to take the state income tax deduction. Yes?
Is the standard deduction different for each household? Like, does the government set a different standard deduction?
It's different per filing status. So you see these different filing statuses that are here. So there's single, married, and then there's head of household and married filing separately. You don't see those as frequently, but you see that that's the differentiator.
Okay.
So part of the changes that took place this 18 were that there's now a cap on the total amount of California taxes, or any state taxes at all, that are deductible against your federal income. So the cap right now, I believe, is 10,000. So before you used to be able to deduct unlimited amounts of state taxes, and now it's only going to be capped at 10. So that's one thing that is really only going to affect the high income earners, because if you're paying 10,000 in California tax, think about how far you have to be up on the bracket before you're going to pay 10,000 California tax. Take a look at, we see taxes due. By the time you hit the 10.23 bracket, you've only paid $2,500 in taxes, right? So you really have to pay a lot in state tax for that cap to apply to you. You're probably doing pretty well if the cap applies to you, is my point. But part of the debate that was going on was people were saying, well, people in high tax states might end up seeing an increase as a result of the legislation. And that's somewhat true, but it may not be the worst thing at all times, because if you're saying that you're going to cap this amount that's over there, then it is true that you may end up maybe owing a little bit more on the state side, but you will get a break on the federal side. So it's like one step forward, 1.5 steps back. That's part of the discussion behind it. But I will say that not everybody is going to see a decrease in income taxes. But my point is, you're only going to see that increase take place for some of the very high income earners. I've kind of spreadsheeted it out. The threshold seems to be around like 200 and change. If you're 200 and change in California, you actually might pay a little bit more just on the state side. Because we all get a break on the federal side. All these rates are less. But because I end up paying less on the federal side, I consequently pay more on the state side. So anyway, that's the point behind that portion of the discussion. Those are some of the major changes that take place. That's a discussion about the difference between itemizing deductions and standard deductions. That makes sense so far. And we'll proceed going forward with this. Last thing we're going to talk about, at least in this portion, are two things. My favorite tax deduction is the retirement savings deduction. And the reason why it's my favorite is because you don't have to waste the money to realize the deduction. So for example, we talked about some of the other deductions we've seen before. Home mortgage interest, which goes right to the bank. You don't get to enjoy it. We talked about medical expenses. People don't really like paying medical bills. And we look at student loan interest. That's another one, for example. No one gets to enjoy that money we pay. But if I contribute to my employer's 401k, or if I decide to fund my own IRA and put my money there, I am going to enjoy that money someday. Because what I'm effectively doing when I save for retirement is I'm putting money in a time machine for my future self. I am going to spend that money someday. And if I invest it wisely, as we discussed in the investments class, then I'm going to have more money at the end than when I started. So I'm going to take my money, I'm going to put it in a time machine. It's going to be much bigger when I'm older, and then I get to spend that money. It doesn't disappear like the interest I had to send to the bank. So when we talk about the retirement savings deduction, two birds, one stone, because you are saving for your future while simultaneously decreasing the number on which you pay income tax. It's very powerful. Think about if you get a 4% match in your 401k at your job. So in my example with the $100,000 employee, that means that the first $4,000 that I contribute to the 401k plan gets matched by my employer, in essence. So this person kicks in $4,000 to the 401k, and the employer kicks in $4,000 to the 401k. So that's a total of $8,000 in my account, assuming a 0% rate of return. And then what I did was I just realized $4,000 in deductions. So I just prevented $4,000 from being taxed at 24 cents. So that's what, $960, right? So I saved $960 in federal tax, probably some more on the California side, maybe, maybe not. But I saved this much over here, and I now have a future of $8,000. So that's like $9,000. You basically parted with $4,000 of your money, and you just realized, in essence, $9,000 in economic benefit. It's going to be that much more for your future, and you're going to owe less to the IRS in the process. Yes?
That scenario makes sense, that's wrong.
Oh, okay. This is a good topic to talk about. Thank you. We're gonna segue to that in a second. So this is different. This is a pre-tax deduction. You usually have a choice when you're saving into your retirement plan at work about how you want the money to go in. You can choose to have it go in on a pre-tax basis, in which case you do get a deduction like this. And that is generally done when you need tax deductions. So if you're in the 22 bracket or above, generally you want to go pre-tax. But there's another option for people who are in lower tax brackets. So we can understand that the value of a deduction increases as one climbs up these tax brackets, right? Because if I'm making over $500,000 and I'm in the 37% bracket, that means every dollar of deduction I can find gives me 37 cents in return. That's amazing. But if I'm in the 10% bracket, well, I'm not that excited about it, because every single dollar I find in deductions, I get 10 cents. It's still good. It's better than 0 cents, but it's not the same as 37. So generally speaking, if you're in a 10 or 12 bracket, you don't really need tax deductions as much, but 22 and above, they really count. And so if you're in a lower bracket, you can actually do something different. It's called an after-tax contribution, or the Roth contribution. And this applies to both Roth 401k and Roth IRA. Really, it's just a way to designate a method in which you're saving into that particular account. Now with this, you do not get a tax deduction, but you pay nothing on that money in the future. You never pay taxes on that money again. And think about how powerful that is for young people. If I make $1 in my 401k that's taxable, and I pull that dollar out in the future, well, I'm probably only going to get to buy 70 cents worth of stuff, because I have to pay 30 cents in taxes, right? Because I have to pay this much to the IRS, and if I still live in California, I got to pay this much to California. So maybe I get to buy 70 cents worth of stuff with that dollar that I make in return in the 401k. But if I make $1 in a Roth IRA, and I pull that full dollar out later, I get to spend that full dollar. Now that may not sound like a big deal for you to say, oh, what's the difference? 30 cents. That's a big percentage increase. What is 30 cents divided by 70 cents? If I go from 70 cents to $1, that's this much of an increase. That's 42 point something percent. But that's a big deal, right? 42% more spending money in that example with the money in a Roth. There's a saying, it goes, it's not about what you make, it's about what you keep. No one cares how much your account is really worth. People care about how much stuff that account gets to buy. So if you think about it, let's pretend taxes are exactly 1/3, just to make my math easy. If I have a taxable IRA worth $150,000 and a Roth IRA worth $100,000, those two accounts get to buy exactly the same amount of stuff, don't they? Isn't that amazing? So when we think about the implication of taxes on what you'll actually be able to buy in the future, it becomes a very big deal. And so you actually do want to have some portions of your money taxable because you want the deductions over time while you're working. But on the side, you want to have a little bit of tax-free money from which to draw in the future, because that's going to be the money that you'll pull upon and actually get to spend all the money that's inside of there. So your question about the situation in which this applies, you're correct. That only applies to the pre-tax scenario. If you funded it in the after-tax scenario, you still get the match, but you don't get a deduction. So what's the right answer? There is no right answer, but the guideline is basically to say, if you're in the 10 or 12 bracket, do Roth, because that probably means that you don't need deductions, and you'd be better off if you put that money into an account where it could grow very big in the future. And I'd rather pay taxes on the money when the amounts are small. I don't want to pay taxes on the amounts when they're big. So if I pay little taxes on little dollars as they go into the account, and remember, because I'm investing that wisely, and by the time I'm 60 years old, that's going to be a ton of money at the end. And then when I pull out all that money in the future, nothing. I pay zero on those amounts that are in there. The saying goes, would you rather pay taxes on the harvest or on the seed? You'd rather pay taxes on the seed. You'd rather pay taxes on the small dollars as they're going in than paying taxes on the big dollars when they come out. You can also change some of your investment styles depending on the account in which you hold it. So let's pretend that I have a big bet on the stock. So I'm betting that whatever I want to invest in is going to triple in value. It's going to be huge. And I have a Roth IRA and I have a traditional IRA. Where should I make that bet? Well, if I make the bet in the traditional IRA and it triples in value, so I triple my money from $10,000 to $30,000, how much will I get to keep? Well, I get to keep $20,000 because I'll take $30,000 and then I pay $10,000 in taxes and I have $20,000 in my pocket. But if I have the bet occur in the Roth IRA, I triple my money from 10 to 30 and I get to pull out all 30 and I pay nothing. So if you have the aggressive bets manifest in your Roth IRA, you get to keep more of it. So maybe you go more aggressive in some of your Roth IRAs. You get to keep more of it. Think about it. So go from $20,000 of spending money to $30,000 of spending money. That's a 50% increase. Who cares what the rate of return is if you are saving that much in terms of taxable spending money at the end of the day? Really, it goes back to the lesson. It's not about what you make, it's about what you keep. So anyway, that is a differentiated discussion about saving into tax-free accounts versus saving into taxable accounts. Generally, if you're a high income earner, you're looking for as many deductions as you can get. And you're not going to have a lot of opportunities to save tax-free money. In fact, if you make too much money, they don't let you contribute to a Roth IRA. In fact, if you look at the cheat sheet, do you see this thing called Roth phase out? So it says 189 to 199 MAGI. MAGI is a modified version of AGI, just so you're aware. It's a little more complicated past the scope of this class. But in any case, if you're married and you make more than $199,000, you are not allowed to contribute to a Roth IRA. They don't let you. If you make more than 135 as a single person, they don't allow you to contribute to a Roth IRA. So maybe in the early years of your career, as you're learning to become useful and as you're getting skills and in a lower bracket, maybe you take those years as an opportunity to fund the Roth IRA so that when you're very successful and earning a lot of money, you don't have to worry about the inability to contribute to those accounts because you already did so during the time that you were eligible. Yes?
So I assume phase out and seeing that there's a range here.
Yeah, that's a good question.
It's the amount you can contribute gets lowered starting at that first number.
That's right. It's a proportional calculation. I'll give you an example. So, 5,500 is the contribution limit for most people that are younger. So let's pretend that I'm a married person, and this is our phase out that we're looking at here. So if I make below 189, which is the beginning of the phase out, I get to contribute all of this, all 5,500, 100%. If I make over 199, I get to do none of it. So if I make over that, I can't do anything. If I'm right in the middle, if I make 194, well, that's exactly halfway between these. I can make half of this. I'm allowed to do 2750. If I'm 2/3 of the way into this thing, which would be 196.5, right? Then I get to do 1/3 of this, which is 1800 and change, 1833. So that's the phase out. When you're in that phase, you basically have your contribution proportionally reduced. So yes, that's what that is. All right. So with the 5 minutes that we've got left, I just want to mention to you that when it comes to tax planning, the goal here is to use the rules in a way that helps you make good decisions. And what I really like about tax planning is that if you follow the rules correctly with the guidance of a CPA who is knowledgeable, or enrolled agent, or whomever you want to utilize as a tax advisor, then these benefits will happen. The code is written in a specific way, so that if you do these things, you're going to see these benefits. That's a certainty, because you're following the rules as they're written, and no one should ever begrudge you for legally working within the confines of what is available to you. Nobody should ever disparage somebody for taking advantage of a legal tax method, because if it's in there, it means that some congressperson wanted it there for some reason at some point in time. And if they don't have the foresight to anticipate unintended consequences, or these loopholes as they call it, that's their fault. You're not at fault for following the rules as they're written. So I just want to put that out there. One thing I want to discourage you from thinking is that I should get a massive refund at the end of the year. That is not the goal. I always tell people, and I tell the story all the time, I hate these H&R Block commercials with the people who are dancing and the refunds that they're getting, and they're happy about those items, because the process of tax filing is just reconciling what you should have paid the IRS throughout the year and what you actually paid the IRS throughout the year. So if you sent them more in taxes throughout the year than you had to, that's what the refund is. It's the same reason that you don't go to a store to buy a $22 item. You hand them a $100 bill and you're excited because they give you $78 in change. That's not something to be excited about. You didn't realize anything in that way. All you did was you got your change back from the IRS. That's all that happened. And it's inefficient to have massive refunds come to you at the end of the year. And I've heard some people argue to me, oh, it's a form of compulsory savings. If I didn't do it, I wouldn't save it. I would spend. Well, that's still inefficient, because if you took that $3,000, let's just say it's a $3,000 refund. If you took that $3,000 refund and you put it into some kind of an interest-bearing account, and let's just say you earned $5 on it, that's $150 that you just earned on that money as compulsory saving. The IRS pays you nothing on your interest as far as your refund is concerned. They got to do things with it all throughout the year, but you should have had that money in your pocket. You could have used that $3,000 to pay down credit card debt and prevent it from compounding at 18% or whatever they're charging these days. You could have used that money to fund your 401k and get the match. Maybe some people say to themselves, oh, I can't afford to put $4,000 a year into my 401k. Well, maybe that refund, so to speak, that stayed in your paychecks all throughout the year would have given you the ability to save into that plan and then double up because they match it for you. So I just want to share with you the alternate philosophy that dancing on April 15th because you got a ton of money back is not a good thing. You actually were very inefficient as far as tax planning is concerned, and it presents an opportunity because it means you can actually opt to have less money taken out of each paycheck. So the goal is to kind of break even, or just get a tiny refund at the end, because it means I did exactly what I was supposed to do. Now, If you experience a large refund because you made lots of changes this year and you started saving into the 401k, or you made a contribution to the HSA and now you are getting a refund, that's actually a really good thing, because that came about as a result of your deliberate actions. If you're getting a refund because of passivity and because you just didn't think to set your withholding at the correct level, that's a bad reason to get a refund. A good reason to get a refund is because you took advantage of some of these strategic things that we're discussing, and then you can make that adjustment next year. So anyway, that's kind of the thinking behind these items as we go through it. It can be a complex topic, but I hope that today's discussion helps to clarify some of those things.
I want to make a couple quick announcements. First of all, there is lunch. It did come. But I want to give you this website. So hopefully you enjoyed Mr. Lim's presentation. If you go out to SDFLC, which is San Diego Financial Literacy Center.org/Mesa, Wednesday on March 14th, you can sign up for an actual hour where you'll meet with someone. Paul will be here, but we're bringing a small army. So you can either sign up for 11 to 12, 12 to 1, 1 to 2. If you go out there and it says the time slots are full, still register. Because if we get enough folks, we're going to try to bring additional folks out to you, okay? So don't panic if it says full. Just register and it'll be on a wait list, okay? The next Financial Literacy Series speaker series is the very next day, Thursday. And so it'll be, and not here, it'll be in 432, but it'll be in this area. We'll have plenty of time. And it will be on smart spending. Andre you want to do your drawing?
Yeah.
So California Coast was kind enough to donate a $25 gift certificate. If you were able to register, or if you want to quickly register, he'll draw that name, and then here's your lunch. And if you're here for extra credit, please make sure you sign in and give me your instructors. If you're faculty, staff, or administration and need flex, that is your flex number 96035. Other than that, thank you for your patience, and hope you have a great day. Thanks for coming.